everyone, and welcome to today's edition of our 7 Investing podcast, where it's our mission to empower you to invest in your future. I'm 7 Investing founder and CEO Simon Erickson. We are, of course, always long-term buy and hold investors here at 7 Investing. But today we're going to take another angle on the stock market, which is short selling and short interest. And what implications could this have for the stock market, for stock prices, and for long-term investors? I'm very excited to welcome our guest today. Evan New is a financial analyst at ORTEX, which is a financial analytics platform for investors. Also an old friend of mine. Evan, it's nice to see you again. Thanks for joining me on the 7 Investing podcast.
Yeah, 4 more fools back together.
That's right, Evan. So we got a bunch to talk about. We're going to talk a little bit about electric vehicle stocks, which is kind of a sector that is heavily shorted out in this space right now. We're going to talk about what a short squeeze means and technically what's going on with that. But maybe let's just kind of give a refresher first and foremost, 10,000 foot level. What is happening when a company is sold short? What does that actually mean?
Sure. So just kind of start with the basic primer. Short selling is when you borrow stock, you go out in the market, you sell that stock at a high price, and your goal as a short seller is to hope that the stock price goes down. You buy back the stock at a lower price and return the shares that you borrowed, because you borrowed shares. You didn't borrow money, you borrowed shares. So it's kind of like it flips the whole buy low, sell high in order. So now you're selling high and then trying to buy low. But there's a lot of important dynamics because, where do you get that stock, right? You have to borrow that stock from somewhere, which is a very different mechanic than just going out into the market and buying the stock if you're a long only investor. And there's a whole industry of securities lending where people, will put up their stock. They're willing to loan out because there are typically fees associated with borrow. You have to pay to borrow most of these stocks. So if you're an investor that has the stock, someone will pay you to borrow it. So that allows you to kind of generate an additional source of income to your portfolio that can add to your returns if you're willing to lend it out, knowing that there's a good chance that stock is going to be used to sell short and maybe push the price down a little bit.
Makes a lot of sense. Now, there's some interesting dynamics, like you said, but the borrowing is certainly different than what we've gotten used to in just buying stocks and then selling it later. Other than selling a stock short, would there be any other reason why somebody would want to borrow a stock out in the market?
And that was actually one of the fairly interesting things I learned recently since I joined this company a few months ago, which is that there are actually a few other different reasons to borrow stock, because I think most people think that the only reason to borrow stock is to sell it short, but there are a few others. Let me pull them up here. So the main ones are settlement certainty. So that's, for example, if an investor needs to borrow stock to deliver on a separate trade that otherwise they might fail. If they didn't actually secure the stock on the initial trade and they need to come up with that stock now to deliver on a trade. Market making. So sometimes a broker will lend out client's list. And let me make sure I'm not mischaracterizing. When a broker lends a client's sell list and borrows the buy list, netting out positions over time to avoid impact in the market, which is essentially, it's like market makers have a lot of, they have to trade a lot to kind of do their role and provide liquidity to the market. And sometimes that involves short selling the stock just to provide liquidity. Collateral. Sometimes people will use borrowed securities as collateral for another trade, such as a swap or a derivatives transaction. Because a lot of times you have to put up collateral for any type of stock loan. So sometimes you get that from another one. These things, it's a cycle of lending, and it's really crazy how many levels it goes. Here's another one that's a little bit more straightforward, which is the dividend arbitrage. So sometimes you'll lend out stock to a domestic investor over the dividend record date to avoid foreign investor taxes on dividends. So, these are, some other reasons out there. I mean, short selling is still the predominant reason to borrow stock, but it's important to know that there's other reasons out there because, ORTEX reports on how many shares are on loan, but that number doesn't match up necessarily to short interest. And the reason is because there's other reasons to borrow stock. And on top of that, sometimes someone will book a loan, but then cancel later in the day, or it will get closed unfulfilled. So they borrowed the stock, never actually shorted it, and then they'll give it back later if for whatever reason they decided to not do the trade. So there's so many moving parts here, and it is pretty fascinating.
There are a lot of moving parts. I know at ORTEX, you guys track a lot of those metrics. It's very useful to actually kind of see this and the implications it could have, especially if you have a company with a very high short interest. The ultimate question I want to ask you next is we can see that a short interest sometimes can exceed 100% of the free float, of the publicly traded float. Before I ask you that question, though, can you define for me what a short interest actually means, or what a free float actually means? And then we can actually get into some of those more complex questions.
Yeah, real quick, let me also mention just where we get our data, right? So ORTEX gets data from 85% of securities lenders at the wholesale level. So we get a pretty good comprehensive picture of the lending market. There's a good 15% of the market that we don't capture for reasons that aren't really worth exploring here because they get too in the weeds. But we do get a very good statistically significant sample of the overall market. So that's why we feel pretty good about the numbers. Back to your question on the free float thing, which definitely has come up a lot lately ever since this whole GameStop AMC saga from last year. But people are, will say, how can you short over 100% of free float? Which is, free float is the estimate of how many shares are being publicly traded today. It's a subset of shares outstanding. So shares outstanding will be some big number. Free float is basically if you look at all the people that are restricted from selling or can't sell or don't want to sell. So, for example, corporate insiders, they have lockup agreements or all sorts of reasons they can't or don't sell their stock. Or if you have a big corporate investor that owns 10% of your stock, they're probably not interested in selling. So, those shares aren't being traded. But, so you look at the free float number, and then short interest is just how many shares have been sold short as of this moment in time. And that percentage, looking at short interest as a percentage of free float, will give you an idea of how heavily shorted the stock is. And the higher that number, the more likely a short squeeze will occur, which is when a short squeeze is when, let's say the stock starts going up, the short sellers start to lose money, and they want to bail on the trade. But to do so, they have to buy back to cover, and that buying pushes it up, pushes other shorts out, and it just kind of creates this self-feeding cycle where you get these huge rallies like we saw in GameStop and AMC. At the same time, a lot of, as we mentioned, fees earlier, sometimes these short sellers are paying really high fees to maintain these positions, to borrow the stock. So if you're getting squeezed on the price action, you're paying huge fees to maintain this position. That's a good, that's a recipe for you to bail on your position if it's going against you very rapidly, as a lot of these cases, that's what happens. And as far as how it can go above 100%, let's say you have investor A holds 100 shares, they lend those to B, B short sells those to C, and now C is long 100, but then let's say C short sells again. So you can, in that situation, you started with 100 shares, but as people keep selling and lending and selling, it's a cycle. You can actually have 200 shares short to 100 shares long. That still nets out to 100 shares, but you also have 200 shares short. Like the way that I like to explain it sometimes in a way that I think most people can also understand is think of like a bank, right? The way a bank works is person A deposits money, the bank lends out the money to someone else that goes and spends the money or lends out again. And, banks create money supply through this lending cycle. It's the same thing for short sellers, right? Like, or for securities lending. Like you have a certain number of share supply, but then as that is lent out multiple times, it has this multiplier effect that is very similar to what traditional banks do that increase or decrease money supply in the broader economic system. So it's fundamentally like the same mechanics. And that's how you end up with a situation where you can have more shares short than exist in the free float.
Let's get back to the short squeeze there for a second, Evan, because this is a phenomenon that, of course, long-term investors or people who are long the stock love to see. You'd love to see a stock price shoot through the roof because of this phenomenon. But like you mentioned, it's because a lot of people who are short the stock, betting against the stock, are quickly trying to bail out of the trade, cover their short positions. And that puts a lot of buying pressure on the stock, which pushes the stock price up. You look at a lot of data out there. Do you have a rule of thumb on the percentage of a share of outstanding shares that are sold short that tends to indicate that perhaps there's a short squeeze possibility in the future? You have a rule of thumbs on that, or is it just completely different for every company and every industry out there?
It's really hard to say because there's so many factors. Certainly the directionality of like the higher the number, the more likely it is, right? But it's hard to say if there's some specific threshold where you start to see like the probability increase or something, because there's so many different like factors that are going into it. For example, like, you know, a lot of times the prices get disconnected from fundamentals when these things happen, because again, the people that are buying this stuff are just trying to get out. They're not buying because of some fundamental thesis or some long-term anything. It's just, I need to buy this stock, whatever price I can get it at. And that leads to this disconnect. But that's why a lot of times you see the price reverts back down pretty quickly. Like most short squeezes only last like a day or two. Whereas this GameStop and AMC stuff has been persisting for a year, in part because those companies were raising capital through the squeezes with at-the-market offerings that actually strengthened the balance sheet. So they actually did change their fundamentals because of the squeezes, which most companies don't go to that extent to like actually lean into and capitalize on what's going on out there. But like there's just so many factors, and like sometimes you'll see a fundamental event is the catalyst, but then the proportion of the move doesn't make sense for like that fundamental event. But so it can lead to very disproportionate movements, and a lot of mean reversion stuff will come back down pretty quickly most of the time.
We'll get to the electric vehicles in just a minute here, but my final question as we kind of wrap up the what's going on out there is, short interest isn't something that's so easy to find all the time, right? It's not just going to be put on the very front page of an investor presentation or anything else. How do you actually calculate short interest? How are you guys doing your calculations for the metrics that you're doing?
Yeah, that's also a really good question, and it's very important to realize how this data works. So the only in the U.S. markets, the only time that the exchanges report short interest twice a month, and there's like a delay of like 7 trading days or something. Like it's like a week and a half maybe, and they report data on the first or the last of the month and like the 15th, right? So there's basically 2 data points, 2 settlement dates per month, where that is the official correct exchange reported data. But because of that delay, if you're a trader and you're trying to create a short squeeze or pursue these types of strategies, you're looking at stale data that's from like a week and a half ago. It's really hard to use that data in an actionable way if you're trying to make these types of trades. But those are the correct official verified FINRA reporting dates. Everything in between those 2 dates is an estimate, and there's no way to know with 100% certainty what the correct answer is at any given time, right? Outside of those 2 very specific closing dates at that moment, right? So everything else, including from ORTEX or any other short interest provider, there's only a couple people that try to provide short interest because it's very difficult to estimate. They're all inherently estimates, and different companies have different methodologies. Again, ours, we leverage securities lending data, and we use many other inputs and factors, and we run through our algorithm, and we do a lot of fine tuning to it and machine learning, and we're always trying to improve the accuracy. But all you can do is we're deriving these real-time estimates every day, throughout the day, real time. That's not to say that estimate is 100% correct at all times, because there's no way to know, right? Like the market is so massive, all these stocks are trading millions of shares a day, and like there's no way that you can say with absolute certainty, as of this moment, this is exactly the correct answer. But what we can do is we look back, right? So we have our numbers that are provided in real time every day, and we provide we track it all in the charts and provide it to our customers. And then later on, when the exchange reports the data, and that's the correct answer, we go back and we compare. We say, how close were we to that number we calculated 2 weeks ago or whatever it was? And then we compare. And sometimes we're off, right? Like these are estimates, and there's a lot of inherent uncertainty with trying to estimate this number. But, and so yeah, sometimes we're going to be off, but sometimes we're very, very close. So, and then we use that information and feed that into our machine learning to improve going forward. And then we're constantly trying to get as accurate as we can. So to the extent that we feel like we're getting close to the right answer most of the time, and more importantly, that we're capturing the directionality of it. So like, even if we're off, we almost always have the correct direction. So if short interest is rising very quickly, we will generally have that trend captured and presented on our platform well before the exchanges report it. And even if the exact number is off by a little bit, you can see that, hey, we're pretty close, and the overall trend of direction is what we predicted it would be. So, that's what we feel good about and confident in that, hey, we're doing our best to provide this very hard number. And sometimes we're pretty damn close. but other times might be a little off. But we're always working to improve that going forward. And we're also very transparent about it. So, for example, on our platform, we allow our users to chart all of these numbers. You can chart an insane number of data points around all this stuff. So for example, you can chart our estimate, which includes confidence intervals of like, that will expand and contract based on like volatility and various factors that affect our confidence in the number. And then you can track the official correct answer, and you'll see them. They tend to really track really closely. So we do feel confident that we are providing pretty good numbers. But again, there's that trade-off, right? It's like our number may not always be 100% correct, but you have it in real time, so you can actually use it more quickly than the correct number that was 2 weeks ago.
Well, we had some fun with this, Evan. We actually had you pull up a report off of ORTEX. It was called The State of Heavily Shorted EV Stocks, Electric Vehicle Stocks. Now, we'll get into the companies in a minute here and have some fun chatting about this, but maybe let's start at the 10,000 foot level. I've talked with you about electric vehicles quite a few times over the years. Why is this sector so interesting for short sellers? Why do they want to short sell electric vehicle stocks out there?
Well, it's funny because, for the longest time, Tesla was the biggest short trade in the market. It was it got 30, 40, 50% of float short at different points. But in terms of the dollar value, sorry, my dog is.
He has an opinion about this. I think you said Tesla, you got interested.
Sorry, go away. Stop, go away. In terms of dollar value of the short position, Tesla's was one of the highest in the market, like in terms of how many billions was being held short. But as Tesla has gone up over the years, the shorts have kind of abandoned the trade. Like, as a percentage of the shares, it's now down to like 3 or 4%. They've just kind of given up. And at the same time, you have all these SPACs coming out, these EV SPACs, and a lot of them are very questionable, and a lot of numbers don't look great. I do think that there are a couple that I do like, which we've talked about before, and we can touch on later. But a lot of them, it is fair to say that a lot of them don't look super strong in terms of the fundamentals or their likelihood to sustain and become viable companies. And we saw one that just declared bankruptcy a couple of days ago, like EV Last Mile or something. So there is some, and there's been a lot of like accounting questions for some of these more questionable ones. Like they've had all sorts of issues with the bookkeeping, accounting, and running out of cash. So I think there is a tendency to group all of these EV SPACs into this bucket of like, oh, they're all crappy companies. But I do think there's a couple that if you do deep enough research that have a little bit more legitimacy. Certainly they're still fraught with risks, just because entering the auto industry is hugely risky and the most capital intensive industry on earth. So it's definitely they're all very risky, but I think that some have a better shot than others.
Let's double click on Tesla a little bit. This is an interesting one that you mentioned, like 30, 40, 50% short interest for a little while there. And then, you've got kind of Elon Musk sending shorts to people that are going short. They get burnt on this stock. Tesla went through the short squeeze, the gamma squeeze, the lemon lime squeeze, whatever it was called. Stock shoots up to $1,500 a share. It seems now at only, according to the report you sent us, 3% of the free float of Tesla's shares are sold short today. That's significantly lower than any other company on this list. Are people terrified of shorting Tesla right now? And how important is Elon Musk to the thesis that is either long or short Tesla, the stock?
Yeah, I think so to your point, if you're looking on ORTEX right now, we have it at 3.25% short float right now. Back in 2019, that was 35%. So
Wow.
Huge reversal over the past couple of years. And I think that it's all related, right? Like Elon has demonized short sellers regularly over the past many, many years. And he's also antagonized the SEC. That's another topic altogether. But, he has been railing against these short sellers for so long. And at the same time, and I think that what that's done is helped, really rally the retail shareholder base to really kind of push back against them. And I think it almost as if that whole topic has kind of created it was almost a precursor to the GameStop AMC stuff, because it creates this kind of ideological aspect to it, right? Like this good versus evil, oh, short sellers are evil, let's rally against them and beat them. Evil hedge funds are shorting it. And I think that some people forget that short selling has some value, right? Not the people that are just speculating, but some of the activist short sellers out there in the market really do uncover corporate fraud that would otherwise could persist for years and result in substantial losses for shareholders, right? Like, I mean, look at Luckin Coffee a few years back. You know, some short seller sent people to China to sit in those coffee stores 8 hours a day, doing on the ground research, taking track of like the order numbers, and really putting together a really comprehensive thesis that there's a lot of fraud going on, misconduct and self-dealing, and like the way that they would funnel money between, you know, cell phone subsidiary, all sorts of shady stuff, right? But a short seller uncovered that, and that was legitimate fraud. There's there's plenty of other examples where it's just like, oh, I just hope this company fails. I'm going to bet against it. And they're not actually doing anything to uncover fraud. They just kind of like yelling on the internet. But I think that, like, you know, people do forget that, like, you know, some good can come of this activity. And, you know, Elon has definitely doesn't see that. He's definitely antagonized and demonized it to the point where, you know, the retail shareholder base of Tesla has really driven up the price, you know, in an effort to kind of drive out these shorts. And it seems like they've won so far.
It's interesting. I really liked that you pointed out this is such a capital intensive business, you know, and like you mentioned Tesla a couple of years ago, I had conversations with very smart investors, you know, CFA charter holder investors that were very convinced that Tesla was about to go bankrupt. Too capital intensive, you know, didn't have the cash flows, they weren't selling enough cars, they were spending a ton of money on capacity and everything else. And now you see Tesla at a 3% short interest versus 50%. But several of them on this list, Evan, you know, these are kind of other smaller companies. I don't think we're still having the conversations about Tesla going bankrupt today, but perhaps some of these other companies on this list, whether it's Nikola, whether it's Fisker, whether it's Lucid, I mean, there's kind of those same conversations that are taking place. Lucid is at least the numbers I'm looking at right now, around 23% short interest, Nikola at 34%, and Fisker at 37% short interest. This is a capital intensive industry. Electric vehicle production is not an easy task by any means. Do you think that there is risk of these companies going bankrupt, or is this excessive pessimism in the short interest that's appearing in this chart for these kind of companies?
I think there's a mix of all of it, right? Like, I wouldn't overgeneralize any of these because these are all valid concerns that you mentioned. But whether or not any specific thing applies to any specific company, that's like on a case-by-case basis, you should look at it. So, for example, like Nikola had some very serious allegations around fraud too, around there pushing the truck down the hill and pretending it was powered by hydrogen. Right. Yep. Mm-hmm. You know, and like that's a pretty valid concern, right? And then there's always concerns about, do you have enough capital to actually ramp production? A lot of these companies don't. Even if, you know, for example, Lucid, which I own and we've talked about and I'm bullish on, I think fundamentally Lucid's very solid. They have plenty of cash. They have a very, you know, strong corporate backer in Saudi Arabia as their largest shareholder. That if they need money, they'll just go to Saudi Arabia, and who's very invested in trying to revamp their image as a country because it's all oil money. They want to try to have a greener image. So I think that, you know, they do have an interest in really supporting Lucid as like kind of a, you know, that's part of their strategy to nationally rebrand. But that being said, so even though I think Lucid has great technology, they have sufficient cash to enter and ramp, and, you know, they do have strong leadership. There's also a question about valuation, right? Like some of these short sellers, even if they're not doing this activist on the ground research that we were just talking about, their thesis might simply be that the stock's overvalued. Even if you think the company is fine, like operationally, you could still argue that the stock's overvalued for whatever reason. I mean, Lucid is like a $30 billion market cap right now, and they've sold like 1,000 cars. So you could argue that there's a big disconnect there. And it's hard to say if you're right or wrong, but that's a valid point. And the stock might come down just from that. The same thing with Rivian. Rivian is extremely well funded. They've entered production. They're not a SPAC. I mean, they went public through a traditional IPO, but similar kind of thing, right? Like there might be very valid concerns around their valuation. When they hit $175 within a few days of going public, which was like $100 billion valuation for a company that at that point had delivered like 10 cars. So even if you think that, you know, these companies have a good chance, even with the risks that they face, even if there's a good chance that they'll make it, there could still be a very valid concern around, you know, when the market's getting too ahead of itself and things are getting overheated around valuations. Like last November, when a lot of this stuff peaked before this whole market, you know, downturn, a lot of these stocks were trading at humongous valuations that I'm honestly not surprised it came down. But maybe the extent you could debate on how far they should have fallen. But I'm not surprised that $100 billion valuation for Rivian wasn't sustainable.
Makes a lot of sense. There's certainly some implications for investors. It's an interesting data point to be keeping an eye on. Like you said, whether it's a quality company that has just got a high short interest because people are betting against it going bankrupt for the wrong reasons, or maybe it is potential that there are problems brewing, maybe fraud is being exposed. It's certainly something to keep an eye on as institutions are taking short interest. Anything else that investors should be watching or thinking about when it comes to short interest, when it comes to short selling, Evan, that we should be sharing with our audience for this discussion?
I think that it's just important to us, because I know that Seven Investing, most of your customers are going to be generally geared towards long-term fundamentals, and I think that probably the biggest takeaway, if you're a long-term fundamental investor, as it relates to short interest, yeah, I mean, if a stock squeezes for a day or two, if I'm a long-term investor, I'm probably going to ignore it, right? Like I'm probably not going to try to call the top and sell it at the top or something. But it's also good to just know, like, if you see a big movement, is it caused by a short squeeze or is it caused by some fundamental news that actually affects the long-term thesis? Or B, I think probably the most important thing would be is, do the short sellers have a point, right? Like, is there a real thesis for why they're short? And a lot of these short sellers are happy to publish their thesis. Like there's plenty of activist short sellers that will put out their thesis, and obviously they're trying to drive the stock down by putting out these short reports. But as a long-term investor, you should read those reports and like the bear to your bull, right? Like, do they have a good point? Like, what is their argument? What is their thesis, and why are they short? And if they're actually giving you a fundamental short thesis, and how does that reconcile with my bullish view of the company's long-term prospects?
Well, once again, Evan New is a financial analyst at ORTEX, which is a financial services platform for investors to take advantage of. More information is more power for you as an investor. Thanks, Evan, for joining me at the Seven Investing Podcast here today.
Thanks for having me.
Thanks, everybody, for tuning in. It is our mission to empower you to invest in your future. We are Seven Investing.